Hello, everybody. Welcome to episode 4 of the Broco podcast. I am one of your bro hosts, Tyler.
And I'm your other bro host, Adam.
Yep, and today we're going to be talking about stocks. So many of you probably heard of what stocks kind of do or that people are investing in stocks. But we're going to kind of do like an intro. I'm a finance major in college, so I learn about this stuff daily. And then Adam has been investing for 20 years
Something
more.
Man, you're making me sound old. But yeah, I've bought and sold a few stocks in my time.
Yeah, so
Taken some losses, some gains.
right. So he has some experience in that area, so we figured we would just come on here and share our experiences with everybody, and kind of help everybody understand what a stock is and why everybody should invest in stocks, right? Disclaimer, we're not licensed financial advisors. This is 100% what was like opinion or ideas,
Things that we have tried.
things that we've tried. Yeah, things that we've tried and our experiences. This is based on our experiences and things that we know and understand based on those experiences.
Yeah. I've lost real money.
Yeah, we both have.
Made real money as well. So, yes.
Right. So, with that being said, to kind of jump right into it, we're going to kind of go over like what a stock is, how to get started, and where to go to get started. So stocks are basically little nuggets of ownership of companies. So a lot of companies that we've probably heard of, Amazon, Walmart.
Really anything that you can buy. I mean,
Yeah.
My computer is a Dell. Dell has a stock.
Right.
Right here.
Coca-Cola. Yeah. And Pepsi, their competitor. Not every company is publicly traded. Like some big ones, like Hewitt is not publicly traded. But most of your bigger companies that you know and buy from consistently, they're going to have some kind of stock out there. So what you can do is you can buy these shares of stock and they're little nuggets of the company and you own that part of the company. You don't do any of the work. So the managers who run and own the business, right? Those people are essentially like your agents. So they're operating for you to operate that company. And in return for that, you're financing their operations.
Mm-hmm.
So companies have two ways that they can finance their operations outside of what they make and have in retained earnings. They can either issue debt, which is bonds, and we'll get into that in a later episode, or they can issue equity, which is the stocks. So equity, basically ownership of that company. So in return for that ownership and that equity that you're putting down, that investment you're making, some companies will pay dividends, and we'll kind of go a little bit more into that here in a second. Other companies won't pay dividends, and it'll be like you're kind of investing your money for the long-term growth. And we'll get into more on what that looks like and what those differences look like kind of later on. But essentially, you're owning a piece of a company, and that company appreciates in value normally over time. They say that the stock market on average increases 10% each year, so there is risk involved. However, I would argue that there's not a high degree of risk involved. I would consider it like a medium amount. As long as you do your research before you go out and do it, you'll be okay.
Mm-hmm.
So it's a great way to build your wealth, right? Quicker than savings accounts. So most savings accounts, you're looking at what, like 0.5%?
Yeah.
In interest. Whereas with the stock market, even if you're taking losses, you're on average going to do better in the long run in the stock market than you are in a savings account.
One thing that I would say is when I go to invest $1 or however much I invest, I'm always considering that money is gone.
Right.
So I would not suggest that you know, invest money that you're not willing to lose.
Right.
And that makes it a little bit easier to take a loss or a gain or whatnot.
Right.
So that's kind of how I look at it.
Yeah. And there's so many ways that you can get started with it. If you bank with like Wells Fargo, they have their Wells Trade account, which they offer it where they can either do it for you, or they can kind of meet you in the middle and kind of be like an advisor kind of role, or you can do it completely on your own. I like to do it completely on my own.
Me too.
Um,
because that's how I roll, baby.
Right. Well, I feel like for me, I kind of know what's gonna happen. You know, if they're gonna manage it for me, if they're gonna aim for consistent growth kind of thing, right? And I want control. Um, Not to say that it's a bad thing because constant growth is also a great thing.
Yeah, it is.
However, you know, if you're wanting to have that control and maybe be able to take a little more risk, then you probably want to have your own control over it. But I don't advise that if you're just starting out, of course. So where you can go to get started, as we were talking about, Wells Fargo, pretty much any bank, I think probably has some form of an investment
Right.
account that you can set up.
Mm-hmm.
Most of them are also going to offer, you know, managed accounts as well. That's probably going to be their principal product that they're going to want you to do because you would pay commissions and such. The most banks and even credit unions, I think, probably have investment accounts. Cash App, surprisingly, some of you might use Cash App if you don't have a bank account. Cash App actually offers investing, and they also offer what's called fractional investing. And Wells Fargo also just launched fractional investing recently.
Yeah, they never had it before until recent.
Right, it's kind of a recent thing that's starting out, but
the only way you would get fractional shares before that was just you reinvesting your dividends.
Right, or them doing a stock distribution.
Yeah, right.
Fractional investing, that's how I kind of do mine. I'm a college student, so I'm broke. I do have some whole shares, but more often than not, you'll find me putting like $5. It's like a $50 amount total, but it like $5 into 10 different stocks because that's just how I'm able to do it, right?
Mm-hmm.
And that's how some of you might have to do it. So the fractional stuff is real nice because it allows you to buy instead of say for like Berkshire Hathaway, it's like several $1,000s, tens of thousands of dollars, maybe even hundreds of thousands. I haven't
Depends
looked
on if
at
it's
it.
A or B.
Right, for A.
Yeah.
For B, even it's over $100, right? So if you're like, well, I don't have that kind of, you know, capital that I want to put down or maybe even give up, maybe it's the risk thing for you, you know, then you can go on some of these platforms such as Cash App. Another one that I really like is Public. Um, there's several different ones that you can use out there. You just kind of find the best one for you.
Weren't you
But
just talking about like Robinhood or
yeah, there's Robinhood,
Schwab? I mean, there's
Schwab,
Fidelity, all
yeah,
kinds of them.
and a lot of those platforms offer the fractional share trading. So it allows you to buy a share of those several $1,000 or several $100 companies that might be out of your price range for a whole share for like $5 and own like a percentage of that share.
One thing too is, sorry to interrupt you, but as you're talking, I'm thinking about buying these fractional shares. Is if you're having to pay a commission on every trade, that gets really expensive. Have companies, a lot of them, I think, have gone to free trades or so many free trades, or
Right.
like when I started Wells Fargo, they didn't really offer free trades unless you carried a certain balance, which I was lucky enough to have. So I got grandfathered into an account where I could get 100 free trades. But then later on, a lot of these companies have come out with, just free trades, period. And that's a big deal because that helps your money go a lot further when you're not getting, a percentage of it taken every time you buy and sell a security.
Right.
So
that's
a big deal. That's
yeah,
what I'm saying.
it's really nice. And
Helps the
then
little guy.
I think like especially with like some of the apps out there, a lot of them offer more options as well. Like
Mm-hmm.
on public, you can do treasuries, which I really like. So there's more options out there on some of these apps that you can use as well with the fractional trading. So it's kind of a win-win situation, especially when you're first starting out. So I would highly recommend, if you're really new to it, like start out with the fractional, maybe on like an app, and just put like $20 on there and try it out.
And it's
And
easier than ever.
It's easier than ever, right? With the internet and everything being connected, the stock exchanges are able to trade live worldwide. So now the entire world is getting involved in stock markets and trading, and now we have a worldwide, we have multiple markets that we can trade in. So it gets a little complicated there, but the benefit is that we are able to be connected like that and be able to have those opportunities, right? So with that being said, now how does a stock become a stock, right? So when a stock becomes a stock, it starts out trading on the market as an IPO, which is initial public offering. And they initially put that out as like, this is our first offer to whoever wants to invest in us and invest their equity with us. This is the first offering. So a lot of times they'll drop it, and within the first few days you'll see a lot of people buy it. So the price will go up, and then when the price starts going up, then it'll start going down. So IPOs, they don't happen. I would say that they're probably not as common as they were like years ago, right? When it first started, but there's still some every once in a while. Like what's the one that just came out? It's kind of like Etsy, but it's not.
I don't know. I haven't followed the market as much on the IPO side. But what I know about IPOs is I've never been able to get into one. It's hard to get into them. It takes a lot of money, and you have to have a really strong relationship with the people that are doing the IPOs. Um, Most people are going to get in on the secondary market on that, where after the IPO is dropped, then they're going to be someone who's going to buy from one of the people who got in on the IPO.
Right. So, Instacart, that's the one.
Instacart.
That's the
Okay.
one that just came out. I
Yep.
want to say like probably 3-4 months ago. Just came out this year. So
I know they've said that some of the IPOs have done a lot better this year
yeah,
than they did because a lot of them dropped in the past couple of years and they didn't raise enough as much money as they thought, or they weren't subscribed to a high enough level. But the latest ones have been, highly subscribed, and they dropped at one price and bounced on the secondary quite rapidly.
right,
So they were a success.
right. So so you were talking about the secondary market. So once they kind of have their IPO, then they go into the secondary market, which is where live trading happens. So people buying and selling actively. And you would go in for your fractional shares or your whole shares, whatever you're buying, and put your money down, and then you would own that portion of that company, right? So, and then we were talking about earlier, some stocks will pay dividends. So, what a dividend is the company makes a certain amount that year, and they have what's called retained earnings. And retained earnings is like the remainder of their sales after all their expenses. So it's their net income. And it goes into their equity account as retained earnings. So as a shareholder, owning part of that equity, some companies will provide the opportunity to share with you some of those profits. And that's kind of what a dividend is.
define what equity really, how they come up with that number, I guess is what I'm saying.
So equity is just another word for ownership, right? So when a company is talking about their equity, they're talking about how much money altogether have all of our shareholders put into, like, as a pot into our company, and that's their equity account. So it's how much ownership is outstanding. How much ownership does the company not have a hold of, essentially, right? So you're financing, they're using your money to operate, and that gets moved into assets, which is a debit account for them. And equity is a credit account. So equity is the balance to the assets. So you're providing the money so that they can get the assets, but in return now you own part of the company. They owe you. They owe you for the money that you provided to them. So that's what equity is. It's essentially you literally own part of their balance sheets.
Yeah,
Right?
I mean, from an accounting perspective, is what I'm saying. Like you have
Yeah,
assets
that's what it
on the
is.
left. Assets equal liabilities plus equity, right?
Right. From an accounting perspective, that's what it is.
Okay.
So if you're not publicly traded, then the company owns all the equity.
Okay.
So they would have owner's equity.
Okay. So that's what I meant when I said assets minus liabilities would equal equity.
Right.
When you balance that formula out, you subtract your liabilities from your assets, that gives you your equity. I just want to make sure everybody's grounded on that, because.
But from any perspective, equity is ownership, right?
Yes.
It doesn't matter even if you're a sole proprietor and you own your own business, the amount of money that you've put into that business is your equity.
Okay.
Right.
So then the dividends come from that equity piece.
Right. It's your portion of your.
So they're returning your capital to you when they're paying a dividend. Correct. And they could either retain that capital or they can return it.
Right. Not every company pays a dividend, and there's a reason for that. There's advantages and disadvantages for the companies when it comes to paying a dividend versus like buying back stock, or paying a dividend versus simply having capital gains. And which that kind of brings me to my next thing, which is so you have dividend yield and you have capital gains yield. So dividends is what they're paying to you. Capital gains is what is not getting paid to you, but it's your increase in value. So when a company takes that money that you provided to them and invests it into an asset, that asset a lot of the times is going to be creating more revenue for them. And so it's going to increase the value of your ownership that you've put down. So you can put down, let's say you put $100 down for one share of a stock, and then they go and invest all the money that they got from everybody who invested in it, and they go and they buy a factory to produce a new product. Well, now when they go and they produce that product and they sell it, now their net income is going to increase, so their value in turn is going to increase. So now your share is not worth $100 anymore.
Right.
Has to grow because the company's assets have grown, and the equation has to balance. So everything's connected, which is really cool because it's a lot to explain, but everything's connected. Everything balances. If they make more money, then they have more debits, and there's benefits and disadvantages to capital gains versus dividends for the investors. I want to talk about the investors. There is for the companies as well.
Right.
And that's a back end thing that is not as important. But for the investors, when you're looking at investing, you have to think about how it's going to affect you, right? So your dividends, that comes to you in that moment, in that year, within that period. The proper term is a period. But when you go to file your taxes, then you've collected that money and it's considered income.
Yep.
So you pay taxes on those dividends,
right,
that they're paying you immediately.
Mm-hmm.
Capital gains, on the other hand, you don't pay taxes on that until you go to sell the security, the stock.
Yep.
So it's like a deferred gain. So there's that benefit to capital gains versus dividends. But then the benefit to dividends is, again, it's in your pocket right then and there. So if you put like 100,000 into dividend stocks and you're getting, you could be getting your bills paid like every month. But again, you're paying tax on that. Capital gains, you have to wait. There's the possibility of it being a loss as well. And you have to wait for the gain to happen. And then you have to sell it. And once it's sold, then you get your money, right? Mm-hmm. But there's that deferred tax advantage. But I think one thing that not a lot of people think about, or not a lot of people know, is companies that do pay dividends, they're incentivized to continue paying those dividends.
Why is that?
So there's like this idea of signals, which we'll get into in another episode. There's a lot that goes into stocks, so there's going to be a lot of episodes about stocks. But signals essentially is kind of how professional advisors go about things, as they look at these things called signals. And it's like, what are the moves that those companies are making, and how does that usually translate to its effect on the stock? Mm-hmm. Right? Companies want to continue paying the same dividend or continue growing a dividend, because if they cut the dividend, it looks like they're not making as much money.
Plus, the shareholders are counting on that income sometimes.
Right. Well, I mean, sometimes it's going to happen, but they want the signals to remain positive because they want people to keep buying.
Right.
And if you cut the dividends, then you're essentially telling all your stockholders,
so
hey,
we didn't going down.
Right. We didn't make as much this year, so we can't afford to pay you as much.
They want to see it raised.
And that's not good, because now it's like, oh, well, they're going down. Now it looks like my money is going to start going down. And then you're going to go somewhere else with your money. Mm-hmm. So they're incentivized to keep that dividend. However, when it comes to gains and losses, there is an incentive to have a gain, but you can't control the environment, right? So they're going to try. There's not a guarantee with a capital gain, right? You can hold on to it for a year and see if you have a gain on it, but you might take a loss. Whereas with a dividend, you're actually more safely, I don't even want to say guaranteed, because some companies it just happens.
They're not guaranteed, yeah.
But they're a lot more safer than betting on a capital gain. Mm-hmm. Because that company is more likely to pay you that dividend every year, because they need to keep your money. Right? Well, which one do I do? Capital gains or dividends? If you're in a spot where you're kind of like our age, where you're in the middle of your life, you're in the prime of your working career, maybe more your age, maybe not as much my age.
Okay.
Right?
Later, I'm in my prime, guys.
You're in your prime of your career, your 30s and 40s. You're in the middle, right? You might want to mix up your portfolio a little bit and do like a half and half, or like a 70-30, or whatever you want your split to look like. Someone like me who's like not making as much money, I probably want to look more into dividends, because I'm not paying that much tax anyway. You know what I mean? Like, I'm not even hardly making enough to meet my standard deduction. So what does it matter if I'm getting more dividends, right?
Good point.
But then if you're in your 60s and you're looking more at getting retired, then it's kind of a similar concept, right? If you're retired, then you're probably making Social Security. Maybe you have some retirement, but you're probably still not paying as much tax as you were when you were making your main job, mm-hmm. wages, right? So you're probably looking more at dividend, and you're also more short term, right? Because you're probably not, if you're like 80 years old, you're probably not thinking, oh, I'm going to live to be 150. Let me invest for the super long term. You're probably thinking, no, I need the money now so I can pay my expenses because I'm not working anymore. Right? So that's where you would want to look more into dividend stuff. Growth is when you have long term. Well, every situation is different. You want to pick the stock that fits your needs.
Well, and this also makes me think of something else. So, there's companies that pay high dividends, there's companies that pay small dividends, and there's companies that don't pay them all. I'll throw out Warren Buffett, just as an example. I've read that he believes that not paying dividends because he believes he can make more of a return for his shareholders by retaining those earnings and investing them in other stuff than paying out the dividend, and that he really only would pay out the dividend when he believed that he couldn't make a higher return himself within Berkshire Hathaway, for example.
Right. Yeah, and that's a lot like with the companies as well and how they operate. When you look at, like, for example, Berkshire Hathaway, like we were talking about, their main thing that they're doing is investing in other stuff, right?
They're buying companies.
They're buying other
They're holding
companies.
company, or they're buying shares and
Right.
share in company.
Right.
Yeah.
So it makes sense that their ideology would be, well, we don't need to pay dividends because we're getting all the dividends from them and then we're just reinvesting it and we're growing over and over and over again. So for them, that makes sense. But for a company like Chevron, who's oil and gas, right, they make their money off of sales. So they're probably more likely to pay a dividend because their goal is to make sales go up. So they have confidence that they can continue to grow the dividend as well. Oil and gas is also a more volatile industry. So growth is a little less not guaranteed. Guaranteed is such a bad word to use with stocks. More probable. It's more probable.
There you go.
Right? It's more probable that they'll be able to continue like paying the dividend than to continue promising that they can continue growing capital gains.
Mm-hmm.
Because oil and gas is a more volatile industry.
So here's I just thought of a growth stock that doesn't pay a dividend. So Netflix. So they're basically reinvesting all their money back into their business,
right?
But they're getting a lot of growth out of that, and then that comes back to an investor's level of risk. If you're not getting paid a dividend, then you want to see a lot of growth like that. If you're going to invest in a stock, and you want to see them taking that money and investing it in their operations,
right,
to grow it.
Right.
I think you should just define what a realized gain is, an unrealized gain.
Right. We kind of sidestepped around it without calling it that.
Right.
So essentially, when we're talking about the capital gains and the losses, there's realized gains and then there's unrealized gains. Your unrealized gains are going to be the gains that you haven't taken out yet. So they're unrealized because you haven't.
Losses, because you can have unrealized losses too.
Right. Gains or losses. It's essentially you haven't touched it yet. The money is still in the company's possession. It's not in your possession. As soon as the money comes back into your possession, so if you sell it, then it becomes realized, and that's when it becomes taxable.
Right, and that's really what it boils down to, whether it's taxable or not at that time, right?
If it's realized or unrealized, yeah. And even the reason why they have to do that is because there's even sometimes situations where you'll come to like maybe the end of the year and you're like kind of in limbo. So you're like in the process of selling, but you haven't sold yet, and then it comes into a new year. Well, you're not going to be taxed for that sale in that previous year because you didn't realize the gain yet. So that's one of the reasons why they have that differentiation there. If it's still in the company's possession, it's your value, but you're not in control of the money. If that makes sense.
At that point, right?
Right, it would be unrealized because you're not in control of the money. You couldn't go and buy something with that share of stock, is what I'm trying to say. And it would become realized once that money's in your possession. As soon as you can go and buy something else with the money, the value in that stock, that's when it becomes realized.
Mm-hmm.
So we talked about the dividend yield, and now we have capital gains yield. So if a company pays both, you add those two together, then that's your total yield for that share or that company, right? So let's say they're paying like a 6% dividend, and then they're projecting 10% growth each year. then your total value that you should receive each year in that stock is 16%. So,
but 10% would be a capital gain,
right,
and 6% would be a dividend yield. And
right.
maybe so, like, give an example of a dividend yield. So, in other words, here's an easy one. So, like, company A is a $10 stock, and they pay $1 dividend per year. So 10% dividend yield?
Yes.
Okay.
Now where it gets a little tricky is how often are they paying you dividends?
Okay, yeah, because
they
could pay quarterly,
right,
they could pay semi-annual,
right, and you
I
have
don't know if any pay annually, maybe monthly, some
pay monthly.
Yeah.
There's even some that pay weekly.
Yeah.
But you have to prorate the percentage because the percentage that they're reporting to you is for the whole year, right?
Mm-hmm.
So I would probably say that a good portion, at least of stocks that I've seen, pay quarterly dividends.
That's the most common, I would say.
So if they have a 10% return, quarterly dividends, so that means they're going to pay you 4 times. So you have to divide that by 4. So that's how much you would get each quarter is 2.5%, 10 divided by 4. But you get that 10% for the entire year. However, it's not like 10% per payment. Like some people get confused about that. So
there's 2 ways to, I'll say, accept them or handle them, maybe. One is where they pay you the cash and it goes into your account, and then you're free to use it for whatever. Or the way that I do it is what's called reinvesting the dividend. So they pay that money, but then they turn around right away and buy more stock in the company.
Right. It receives capital gains treatment.
Yeah. But like now, if you get paid $1 a year and you're investing $1 in a $10 stock, there's that partial share. You get, 10% of a share. So now you own 1.10 shares. And then the next time you get your dividend starting the next year, now you're getting a dividend on 1.1.
It compounds.
Yeah, that's the word I'm looking for.
Yeah,
I couldn't spit it out. It compounds.
Yeah.
Yeah. Okay. So I just want to throw that out.
Yeah. Some companies will also do repurchases of stock. So they'll actually go out and they'll offer and they'll say, hey, let's say the share's worth like $30 right now. We'll pay you $35 to buy the shares back, and they'll buy the shares back at a premium, a certain amount. So there's also opportunities like that. That's not as common. I don't think I've ever seen that personally.
Share buybacks?
And I think it's probably a lot less common for an offering, but it does happen where they'll go out, and I think it probably happens more often on like the higher up, the board who has like 10% ownership in the company or whatever. But they go to the investors and they send them a message and they say, hey, we're looking to repurchase however much equity of the company, and we'll pay this much for it. If you're interested, here's what you need to do, kind of thing.
Mm-hmm.
And then they'll buy back that certain amount that they need to meet their capital structure requirements.
Right.
They want to decrease their debt. Or their equity.
Yeah, they want to reduce.
They want to change the debt equity ratio.
Right.
Which that's a capital structure thing. So that again has to do with how they're setting up their budget and things like that.
But that could cause the stock to go up if there's less shares available, correct?
Right.
So that is one way that instead of paying dividends or investing back in the business, they can buy back shares.
Right.
And that's one way that they can help drive or invest the capital to your benefit.
So the last thing that we're going to talk about here for part 1 is beta. And beta is a measure of the stock's risk. So basically what the beta is measuring against is the market. So if a stock has a beta of 1.0, then that means that it is 1-to-1 with the market. Whatever the market's doing, that stock is doing as well. So if the market's up, the stock is up. If the market's down, stock's down. So the closer that a stock is to 1, the more in line it is with the market. And then if you have a stock that has a beta that's over 1, then it's getting more risky. So if you have like a 2.0 beta stock, then that means that if the market is crashing, then that stock is like off a cliff. And if you have like a beta that's less than 1, so if we have like a 0.5 beta stock, then that means if the market is like absolutely crashing, then that stock is like probably steadily declining. It's also a good way to diversify, right? Which is a huge, huge important thing in stock investing. So if you have a stock of beta 1.0 and you invest half your money into that, and you have a stock with a beta of 0.5 and you invest the other half your money into that, well, the beta of your portfolio is the weighted average of those betas.
0.75 then?
It would be 0.75 only because you invested an even amount.
Right.
If it wasn't an even amount, you'd have to prorate it based on that. But essentially, you can create your own portfolio with stocks that aren't at 1.0 and make it as close to 1.0 as you can get it, so that you can have that certainty. They also have negative beta stocks, and negative beta stocks are really weird because they're like the inverse. So if the stock market's crashing, then it's like going up. So it's like really weird. Like right now with the pandemic and them raising the interest rates and things, negative beta stocks are actually doing really, really well. And it's kind of a backwards concept because everything else is not doing very well, but those are doing really well. One example that I didn't even know that it was a negative beta stock, but WD-40, the brand that literally makes like oil, or
it's a lubricant.
It's a lubricant, yeah.
Yeah.
You've probably all used it at least one time in your life. And they are a negative beta stock. So right now they're actually doing really well with the market turmoil. And on part 2, it'll probably be one of the stocks that I show as like an example, and you guys will actually see on the chart that it's been weird. Like that first amount when it started, it's been pretty consistent, and then when the pandemic hits, you can see right there in like that 2020 range, it just spiked. It's the weirdest thing ever.
Can I ask one question on the beta before you move on?
Yeah.
So when you talk about market, are you talking about the Dow, the S&P, the NASDAQ, or are you talking about all stocks for everything? Because you're saying it's compared to the market.
The Dow Jones Industrial Average, the S&P 500, those are stock indexes.
Yep.
So those are just groups of stocks that have a similar...
So when you say the market, you're talking about all stocks.
The general, yeah, the external market,
okay,
as a whole, the environment.
Okay.
So right now we're in inflation, and we just got out of a pandemic. Pretty much everything, the general trend of the market most recently has been a down market.
Okay, I see.
That's the general
You're
trend.
talking about everything.
Okay. Yeah, the general trend. It's sometimes hard and subjective, and I think a lot of people, they created the indexes for that reason.
Yeah.
But what beta is for each individual stock is it's literally a measure of what kind of risks. So it takes into account corporate risk, business risk, the market risk. It takes into account a lot of different factors.
Okay.
Individually, but the market wise, it's a correlation. It's a correlation measurement of how much risk you're taking by investing in a stock. Because if you invest in like Amazon, that's a pretty well established stock, so you're probably not as likely to take a loss. And so they probably have a beta that's kind of closer to 1. If you're like less risky, right, you're probably more established, and if you're more risky, then you're probably newer, using more leverage. Like I know REITs, a lot of REITs are a little bit higher beta, but they're also higher return.
Mm-hmm.
But it's because the real estate market is so volatile.
Mm-hmm.
So you're taking more risk by investing your money in the real estate market, but you're also potentially having a return. So there's also an inverse relationship between the risk and the reward,
Yep.
which I'm sure all of us know. That's like a common phrase in life: no risk, no reward, right? It's literally the same thing in stocks, right? If you're not taking any risk, then you're probably going to have a less of a reward. That's why it's important to diversify with your portfolio so that you can have, something with a high beta, but it doesn't matter because you got this over here with a low beta. So you're balancing out. You can still make those high returns when they happen, but then also mitigate against those losses.
Cool.
So there's a lot that goes into it. And in part 2, we're going to actually go through and like show you guys some examples and actually go through the numbers and show, some other tools that you can use to kind of identify what kind of stocks you want to invest in. So with that being said, we appreciate everybody watching. Hopefully everything was clear. Yeah, and listening. Hopefully everything was clear and made sort of sense. I know there's a lot of information that we threw at you today. It's a topic that we're so passionate about, and we're still kind of trying to figure out how to disseminate it. So, with that being said, thank you so much, guys, for watching and joining us as always. And then we'll see you guys in part 2.
All right. See you guys.
Thank you.